tokenization has found product market fit. I certainly believe, and it's got far to go. In fact, one of the great applications is on-chain settlement. And we have an amazing panel for that. I'm very excited to introduce Lauren Berta, who's the product lead for stablecoins and tokenization at Ripple. You can come on up, Lauren. Raja Chakravorti, Chief Business Officer, Stellar Development Foundation. We also have Glendy Cam, Chief Product Officer of Tassat. Nitin Gaur, Senior Advisor for Nethermind. And last but not least, moderating this panel is Chris Storaker from the Defiant. I'm excited.
All right. Hello, everyone. Thanks for attending this panel. Really excited for this conversation. So let's get started with well, maybe we can do like a quick round of introductions. Maybe you can share briefly about who you're with and something exciting that you're currently working on. So yeah, you can go.
Thanks. My name is Nitin. Glad to be here. I lead the head of institutions at Nethermind. And my focus now is how do you make institutions comfortable with doing business on chain, which is building new financial structures, settlement on chain, and making this entire tokenization a reality for regulated financial institutions. Prior to this, I spent time at IBM, founding Blockchain Labs, and at State Street. So glad to be here.
Glendy Cam, Chief Product Officer at Tassat. Tassat is a blockchain payment settlement company. We put tokenized deposit in banks and also launched tokenized money market fund last year. Right now, we're focusing on the stablecoin strategy, something very exciting coming soon.
Hi, everyone. Raja Chakravorti. I'm the Chief Business Officer at the Stellar Development Foundation. Stellar is a layer 1 blockchain that's been around for about a dozen years. We originally were very focused on cross-border payments, and one of the areas that we have had tremendous focus on, particularly over the last year, has been on real-world asset tokenization. It's an area I think that we've been very, very focused on growing, and we actually just eclipsed $3 billion in tokenized assets on Stellar, so check out my LinkedIn posts. I have a great one there, and I'd say really excited to be here, and I can't go without saying just go Knicks. I'm still vibing off that win. Hopefully some of you are too.
Hi, I'm Lauren Berta. I'm the stablecoin product lead at Ripple. Ripple is a digital assets infrastructure company. Similarly to Stellar, Ripple builds on an L1 called the XRPL. That L1 has been around for 12 or 15 years. Ripple has always provided payment services to their customers, and then last year, on top of that, added the acquisition of G-Treasury, a TMS service, which is now Ripple Treasury, and Hidden Road, a prime brokerage, which has now become Ripple Prime. So a lot of services.
Oh, fantastic. Okay, I think this room speaks to the explosion of interest that we've seen in digital assets, tokenized deposits, and stablecoins. So let's start by getting your perspective on how much of this is coming from regulation finally landing, how much of this is actually the rails being mature enough for institutional adoption, or how much of it is plain FOMO in your perspective. So maybe we can start from the back.
Yeah, I'm going to attribute a lot to regulation. I think, I've been at Ripple for 4.5 years. Ripple's been in the business for 10. We've been talking to banks the whole time. The conversation post-Genius completely flipped from, can I hold this thing? What is this thing? How do I treat it? To now the efficiencies, the liquidity unlocks have become really obvious. And we get to the point of the conversation where we get to the accounting team and they say, how do I pay my taxes on this? And I think that's a really great maturity we've reached. I think that initial decision of, well, maybe I should say that blanket of Genius compliance is really important, especially when, at least in the stablecoin world, two of the major, well, the two leaders of the stablecoin market, both of which will have to change next year to be Genius compliant. Circle obviously much less than Tether, who won't end up being onshore. But even USDC has to move from that MTL to trust model, providing more sort of a structured trust, that blanket, it's genius compliant, it's out of a trust regulated stature, and that means I can use it as a treasurer.
Yeah, I think on my side, I think they all have a role, but I think the sequencing is what really, really matters. And maybe the best way to bring this home is just an example of a partnership that we've recently engaged in. So DTCC, as Nitin knows, is a post-trade infrastructure for securities, and they have announced and launched their tokenization service. Now, they received a no-action letter in December 2025. And we actually announced a partnership with DTCC about 6 months after. And that wouldn't have happened had the regulation not been there to create the comfort for them to do it. But I think the nuance around the infrastructure is actually like the thing that really, really matters, because the reality is, we are working together, and certainly there's the idea of low cost, fast speed, immediate finality. All those things matter. What I think matters more is that we spent the better part of a decade working with Securrency, which, for those of you who don't know, Securrency was actually acquired by DTCC, which is now basically DTCC Digital Assets. And the work that we did with them to ensure that there were critical elements like clawback functionality, like asset issuance, the ability to really create all of the control factors that are necessary when you think about traditional finance and kind of that segment meeting a public blockchain. There still needs to be those asset control features that are developed in there. That is really, I think, the thing that gave them enough comfort. And so that is the next piece that matters. And then finally, I think the FOMO thing is real. I think it is more of like a lateral maneuver rather than something that has happened sort of afterwards. I think what we are mostly seeing, it's not just like crypto traders making this thing happen. It is institutions are seeing their peers. They're seeing that there is likely some sort of efficiency. They come to panels like this. We talk about all of those things, and they're saying, okay, well, I don't know yet exactly how to apply it, but I need to actually start thinking about the application of it within my own within my own house to start to see if I can also find that same efficiency. But I do think it's really important to think about the sequencing to see kind of what has happened today.
I don't think we're gonna dispute that regulatory clarity is definitely a huge catalyst to make things happen. When you don't have that kind of transparency, when institution doesn't know what can be done right and how to do it, it's hard for them to put in meaningful investment into this technology or creating product and services. Tassat is one of the very first company to put tokenized deposit into banks and also process large amount of deposit and transfers on the platform. And then after a while, because of the regulatory opaqueness, a lot of the institutions just pause and just hesitate to invest into it. But now we can see that the environment completely changed, and people are willing to invest, and people are jumping into it. But also in parallel, I think something also happening at the same time is the infrastructure maturity that's happening. While people are waiting, there's a lot of build out in the industry. Few years ago, even institution wants to do it, they find it very difficult. Like if you have to build out a platform or services, you have to think about the compliance tooling and wallet management and custodian service that you can provide to your customer, as well as treasury management, how to integrate into the bigger ecosystem, as well as settlement. How would they be done? Right now, there are so many options out there. Institutions can easily make a decision to buy, build, or just partner. So I think that is what's making the huge difference and why the industry is really booming right now.
So I would say that my previous panelists have stolen the thunder. I was going to make the same points. I think if you look at the quantum of stablecoins, which was pre-Genius, or about 280 billion. The moment we had regulatory clarity, now it's 580 billion, which is aggregate of all liquid instruments, is money market funds and stablecoins. And so the reason why this is important, to Roger's point, is You begin to enter this in capital markets, enters collateral management. So all these things become relevant in terms of this new liquidity infrastructure that emerges from the ecosystem. So I think that regulatory clarity definitely has a big role to play in terms of the act of tokenization is nothing cool anymore. It's been done for some time. The tech has been maturing a dozen plus years from your chain perspective. But I think the challenge, which is no FOMO anymore, the challenge is, at the end of the day, all these tokenized assets end up with the older system. We go back to money market funds. We go back to the back office systems that manage these assets. And I think that the challenge, which is why I think the G Treasury acquisition was quite smart, is velocity mismatch. The old systems based on batch, it's got all kinds of challenges, which is what blockchain is trying to fix. And suddenly now you're dealing with two different systems that have a velocity mismatch, that has a modality mismatch. And I think that industry needs to spend some time in terms of reconciling those two sort of systems together, which is where I think the rubber meets the road at the moment. So I'll pause here.
Absolutely, and I think we need to deep dive in those like two worlds, two speed worlds that are colliding in a way. And let me complain a little bit here. Like on the media side, many of the institutions that are represented here have become sort of like press release machines. And I wanted to poke, if I may, a bit on what is actually gaining traction in terms of real world adoption and going beyond traditional, like crypto native trading use cases. Where are we seeing solid recurring volume being deployed in a way that goes beyond an experiment, a pilot, where it's actually replacing other, like production flows and liquidity? Who wants to go first with that one?
I could go again. I feel like I spend every day talking about 24/7 collateral movement, whether it's for margin trading, to post, to buy a futures contract. Just the fact that you can't collateralize your position on Saturday and Sunday, it's a night and day difference for revenue for a lot of capital markets firms. And it changes everything. I think it's interesting because it is so simple, but it removes, at the retail level, some of these, maybe if we talk prediction markets, like these future contracts offerings, they can take the settlement risk of some different retailers if they offer, you can post that bet on a Sunday. But that just that's not possible at the wholesale level. And so using a stable coin to enable that settlement over the weekend really is changing the game for that market.
Maybe just, I definitely agree with that. I think, I also like to take it back to the basics of what are we actually doing here and who are we affecting? And so a lot of our focus was around cross-border payments. And I think that is undoubtedly a place where you see a lot of value. Really, wherever you see embedded friction when money is trying to move from point A to point B is where we see a lot of that value. And so correspondent banking fees are high, creating cost, creating a lack of kind of confidence. Those things are real. When you look at specific corridors, so if you think about like in Latin America, where you have certain issues that may range from currency currency volatility, inflation risk, lack of confidence in the government. All of those areas actually are what drive, I think, a lot of that value and that volume. And so when I think about like what is the opportunity set here, I don't think it's replacing flows that the existing payment operations already work decently well. I think that's like a much longer term thing to see the adoption. Where you see existing issues and where you see a pull function is where we're starting to see repeatable volume. I would put humanitarian aid for actually to be in the same context. Like imagine trying to send a bulk disbursement into a conflict zone. That is a very, very difficult payment flow to be able to execute, but that is where stablecoin through a bulk disbursement platform like the seller disbursement platform is actually valuable. And so I think those are the additional opportunities, in addition to the ones I think certainly like that we see on the B2B flows or internal treasury management. That makes a lot of sense. But that's where I think we'll see the repeatability. And over some period of time, that adoption may flow into some of the kind of more tangible flows that us sitting in the United States see. But I would say I don't see it yet being the transitional element. I think there's still a long journey to go.
I actually want to piggyback on some of the points that you made. I actually find that really interesting is changing the perspective a little bit. Instead of looking at using stablecoin to create another standalone product or services, is what we are seeing right now is stablecoin is becoming an infrastructure. Such as what you mentioned about cross-border payment and FX payment, is slowly creeping into the infrastructure layer where the traditional financial services is riding on it. So I think that is actually a very interesting transition right now is we're not just looking at how we're going to use it to create another product, facilitate another payment flow, but how it's actually become a more critical core infrastructure component in our existing financial system.
And sorry, I wanted to follow up on that, Glendy, because we heard about the stablecoin use case, which is the open permission, and we're talking about remittances and humanitarian, which is more like B2C or even peer-to-peer sort of transactions. But for Tassat, it's the focus has been on the trillions moved by banks that typically take place over private, more closed ecosystems. Mm-hmm. So what would be the tension there between those two perspectives? Are they compatible? And why do you think one model might be best suited to serve institutional?
Like the tokenized deposit for banks and also versus stablecoin. Okay, so actually that's something that people ask all the time, and I love this question, actually. I don't think that we should look at them as competing model because they're very, very different. Genius Act came in, and then now we have some regulatory framework how stablecoins should be structured, should be issued. And one of the largest debate right now is about the yield situation. Mm-hmm. And tokenized deposit is sitting in bank. Bank is already a highly regulated entity. It is there to, when you have a tokenized deposit with a bank, it preserves a lot of the characteristic of our deposit account, right? You can earn yield, you can have FDIC insurance on top of that. But that is not really the intention of the public stablecoin that we are creating. It is by design that we want it to be a payment instrument. So I don't think they are competing. So the question is, so I don't think it's a fair question to say whether the bank should do tokenized deposit or should support their customer using stablecoin. I actually think that they are complementary. Bank can continue to issue a tokenized deposit and then also at the same time offering stablecoin to their customer because they are very, very different characteristic and also usage. Stablecoin really offer up a lot of opportunities for engaging much bigger ecosystem, blockchain network, and also cross-border payment. But tokenized deposit are providing a lot of the protection and characteristic that we have with our deposit account. And also, I also think that the biggest opportunity of stablecoin is not turning it into a deposit or saving instrument, but instead is actually a conduit to support the transfer between tokenized deposit, settlement asset, and then also engaging in digital asset services.
Can I add one thing? Because I think the point's really great, which is I think there's a tendency to just think that all of these are the same thing, and they're just not the same thing. Tokenization, blockchain, it is just underlying infrastructure to support financial instruments to do the activity that they do. And so without a doubt, stablecoin, money movement, the tokenized deposit, bank, tokenized treasury, yield, these are all different instruments. I think the interplay between them is actually what matters quite a bit. And so what I think the innovative like some of the innovations that we're seeing are like these sweep funds that are able to transition like a tokenized treasury where you're generating yield, sweep that, turn it into a stable coin to then be able to go ahead and facilitate the movement of value very quickly and then be able to do that. I think that's where you start putting these component building blocks together to make something, I think, very unique in terms of the value that it creates. But I think without a doubt, these have very complementary structures rather than competing structures.
Absolutely. I think they're really actually very interconnected rather than you pick one and then you discard the other.
And sorry, Nitin, I wanted to ask, you work with like substantial organizations, IBMs, State Street Advice, DDCC. When an institution is thinking about what settlement asset it's going to choose, what are the characteristics, the dimensions, the feature set that they're going after?
Yeah, since you mentioned DDCC, I advise them. I don't speak on their behalf. I don't represent them. I have to make that sort of statement per se. So my perspective is informed with the client conversation that I'm having, that we begin to now shift from payments, which was the last year's conversation, movement of money, to liquidity optimization. So every financial institution has a hierarchy of liquidity, starting from cash, T-bills, money market funds, treasury, private credit, and oftentimes a lot of treasury function begins to understand as to what the liquidity profile and risk profile and manage the short-term liquidity. And it's a very arduous, labor-intensive process per se. Suddenly you have these tokenized assets which have removed the duration risk to a certain extent, because now I have real-time mobility of assets. Second thing is that the reason I'm explaining this whole context is then you have collateral. Collateral essentially goes into the 13 trillion in the US, 25 trillion globally that moves across these repo markets, which is ability for you to get liquidity, access to liquidity for short-term sort of needs for large financial institution becomes relevant. But most settlement, so there's a clearing and settlement system in the United States and globally, settlement has for securities and many of the capital markets has to be done with central bank money. And it's a legal requirement in many countries. And so at that point, neither stablecoin or tokenized deposits to a certain extent are central bank money. So at that point, we look into money supply, we look into can we use them as collateral to then get access to central bank money to settle, but there's not enough market depth to many of these tokenized assets. So what we're trying to figure out, and I'll say one more thing and I'll pause, is that if you look at DeFi markets, DeFi market average stablecoin recycle like 7 times a day. So you have 33 trillion. In fact, the payment volumes have grown exponentially in our world than Visa and MasterCard because of the fact that stablecoin has a higher velocity elements. If you were to take that construct into capital markets, I believe that the moment you reach 1 trillion of liquid assets, you begin to find the velocity of asset increase and build this new structure, which is what BlackRock's of the world and asset managers are doing in this context. So to me, the liquidity framework or the support framework that's needed by capital market is still in its infancy. And I think regulatory clarity and some of the systems that we're building are essential to reach the point where we can begin to now envision the world we've been talking about for the past 14 years or so. So I'll pause, see if that made sense.
Yeah, I'd love to add, I totally agree on the central bank money issue. That's going to be very interesting how that works out for tokenized money market funds and the sort. I did want to provide the treasurer's point of view as well. So if you're just thinking about, I'm a treasurer, I want to settle my payment, how am I going to choose what on-chain asset to use? Practically, this case sort of has a step back mechanism. So you're going to say, do I have a payout partner? What stablecoin do they accept? And I said stablecoin, but it could be a tokenized deposit. It could be an RWA. Right now, I also think there's an interesting pattern developing between this sort of open model stablecoin, which is like Ripple's RLUSD, USDC, USDT, PYUSD, PayPal's stablecoin, and a closed model sort of like corporate ecosystem stablecoin, which you see in MoneyGram, Western Union. Deal has had one come out, and Stripe is using USDB from their Bridge acquisition. I think as this matures, there will always have to be choice, and choice is extremely important. I think if a lot of treasurers had a million choices, they would choose to bank at a GSIB and use, in the US, RTP if possible, or FedNow. And then if they can't do that, which is very often the case, then you'll go into, okay, should I use a tokenized deposit? Maybe they're doing cross-border payments, and that access point to the correspondent network is difficult to get. It was interesting. I was on a panel with the chief innovation officer of Swift. They're building a blockchain. They're building some payments mechanisms, but he really stuck to his guns of correspondent banking works. And I think that sort of really brought home to me how important and how big a change this was going to provide. And so I think coming back to the point there of what settlement asset I'm going to use, I do think there will definitely be firms that use tokenized deposits if they have those bank accounts open, and there will be many, many firms that use other assets, open closed network stablecoins, based on who their most common payments partner is.
So can I ask one question? Sorry, I know you're asking questions, but the whole G-Treasury acquisition, I think to me, the biggest impediment, and Raju would agree with this, as we've all been working and figuring this out, is operational risk is the biggest issue. So we are moving money all around the system. We have different forms of money. We have different tokenized forms. At the end of the day, treasury and liquidity management is really a back office function. And they have to, so the reason I'm looking at you is because you acquired G-Treasury, and where is the perspective in terms of making that tokenized asset ready? Because all of these systems are in some form of core banking system, and I would know it because I used to work for IBM. We built the system back in the day. So where is the sort of, how do you fix the harmonized operational framework? Because suddenly now you have the same desk dealing with tokenized money market fund and dematerialized money market fund, and they have different risk profiles now, while the asset class is the same.
I totally agree with all this. I think I'm going to name 3 things that I think are huge here. One is the regulatory clarity. We have it with Genius. I think it is ambiguous whether RWAs, tokenized money market funds, belong in Genius. And I do think we definitely need to clear that up. I think when that is cleared up in the US, so we can start getting these issued onshore, that will unleash the same sort of wave that we saw in stablecoins in the past year. So that's first, and the boring one. But the second, the acquisition of G-Treasury. So if you think, again, the treasurer's point of view, you're looking at your TMS, you're looking at your different payment rails, you're looking at all your bank accounts. Some of your banks have sort of this like e-money experience where you can do your book-to-book transfers. And then you're looking at your money market funds and your positions. With the regulatory clarity, I do believe we can get to a place where those positions, while they'll still, of course, have risk on the issuer, will have, the risk profiles won't vary so much. I do think that's very important, but past that, on the operational side, truthfully, in my experience, I've done a lot of work on Ripple's mint-burn product for the stablecoin. All a mint-burn product does is match cash to stablecoin. Every time we receive money in the reserve, mint the RLUSD to wherever it's supposed to go. And while it's really boring, that matching engine, the infrastructure for that doesn't exist in crypto. And so while wallets have come a long way, especially at the institutional level, custody's come a long way. I think we've done really well to have better data, better oracles. Chains have gotten faster. The introduction of privacy over the last few years has been really important. That divergence of fiat to crypto, the expense of on-off ramps, and that operational difference, I think we're going to see a lot of products that focus on that in the next couple of years.
I think that's actually a very good question, because I've seen when RTP was launched and then later on FedNow, I was actually involved in RTP from the very beginning back in 2015-16, I think. We saw that corporates had a hard time adopting it because it impacted their operational process. You can tell them all the benefit, like you can get the money instantaneously within 6 seconds, but then they were like, well, but my operational process cannot support that. And you can see in US, we still using ACH, huge amount of ACH transactions, huge amount of check transactions, believe it or not. I mean, people overseas would think that, wow, I can't believe you guys are using checks, but we do. And operation is is definitely a very critical part in any kind of this kind of payment adoption. But what we have seen in maybe the RTP and the FedNow story can shed some light into how digital asset would become that the instrument for fast money movement is we see that the user interface layer is really important. When you are providing a layer or a platform that abstract the complexity of the integration, the usage, that would make the difference. And then we actually see this is how like RTP start getting adopted because of all the e-commerce and more digital forward company, they start adopting it, and then slowly it start to move into more traditional financial services and corporations.
I think this is like a great conversation. So there's three individual points that I think I just wanted to touch on real quick. The first is I totally agree. When I'm talking to institutions, like that's why a lot of these things are still at the pilot level, because the operational component is very, very difficult. In fact, when we talk about 24/7 settlement, many institutions aren't ready for that. 24/5 start there. Actually, just something more than 9 to 5, 5 days a week. Like that is still very, very hard. The reconciliation around like, oh, I can always audit all of this stuff because it's on chain. Like you still have to also build some of that functionality and then be able to ingest it and then be able to reconcile it with all of your other flows. And by the way, as a financial institution, what I'm likely doing is sending out a digital team to do a pilot and test it, but I have all of this other stuff going on at the bank, and to really adopt it at scale, that is a very, very hard thing. So I agree, like the operational complexity is critical, and I think it is going to take a lot longer than people expect. Like there's some clarity here, okay, great, but it's like kind of clarity to like slowly dip your toe in, I think is what I'm seeing. Okay, so that's one. Second point, interoperability across all of these assets, I think is actually the really important thing. When we're talking about all of these different assets, I think the risk isn't that the stuff works. I think we can see the stuff works. The risk is fragmented liquidity within each of these different asset types. And ultimately, like if you think about like the end state, I have to pick and choose which asset I'm going to use, and I can only settle in that. That's not a very good experience. And so how do I, like, that can work for me in certain flows, but over some period of time, that needs to break down. Those barriers, I think, need to break down. And so I tend to think that interoperability is probably like the greatest long-term unlock, because all of these digital assets should just be digital representations of asset flows that should all be able to kind of work together. The last point I would just make is the last mile component, which I think you were touching on, which is, I actually think this is probably most present in some of these like cross-border like remittance flows, specifically like when you think about like a MoneyGram. I think where it is a really interesting property, and honestly, we with Stellar work very, very closely with MoneyGram. But the thing that was hyper valuable for them is that actually being able to, you can transfer the digital asset into like a wallet that can be leveraged within MoneyGram, but being able to off-ramp that into a fiat currency in a local manner, like literally going into a MoneyGram location and being able to take dollars out, or whichever local representation, that's really important. So I think these three components, like operational complexity has to be solved, but isn't going to be solved right away at the institutional level. Interoperability, I think, for creating like an actual like full-scale adoption, and then like that focus on the last mile, whatever it is. I think those are the component pieces to me that create a system that works.
Great. One thing that's interesting hearing you discuss the topic is that, okay, we mentioned liquidity being a major concern for institutions, the operational complexity of integrating this back into the traditional workflows and having, treasury teams and risk teams, compliance teams manage, these new rails. The challenges around adoption and usability and, making sure that the experience works for the end customer. But in that discussion, one thing that was missing, and I wanted to get your perspective on whether it's a settled matter or not, has to do with the settlement layer itself. So for those who have been in crypto for a long time, we've spent most of their time arguing about finality, transaction finality. We're going to use CK, zero knowledge proofs, to preserve privacy. We're going to do this or that to the protocol standard. Has that discussion been fully settled? Why are we seeing, significant amounts of capital going into certain types of blockchain networks or ecosystems versus others. Is there any room for technical improvement, and what might be missing there?
Settlement, are we settled on settlement, is that what you're asking? Yeah. So I'll say this, we spend thousands and thousands of hours on legal finality, which every blockchain has different sort of true finality, and in our system, the legal ownership, it's all about ownership, right? That preserves our capital markets, that preserves our financial system, who owns what. And so we have spent, at least I've spent thousands, even I'm not a lawyer, I feel like I speak the lingo now in terms of what does it mean to achieve transaction finality on blockchain, and eventually do an action with it. So if you have an asset, you can pledge it, you can collateralize it, you can buy and sell it. And that velocity is different from what happens in traditional financial world, which is T+1, and eventually some are T+0. So that context, I don't think we are settled yet, because now you have a mismatch between different blockchains, 12 seconds to 1 minute to 1 week in some cases, and that is not an efficient system because it's not predictable. So this interoperability thing that you all talk about, such an important part, such an important unlock, as you mentioned, Raja, is the fact that we have to have a harmonized, consistent framework, which is a technical challenge, and we have to solve that at a accounting level, because blockchains are ledgers, but they're not accounting systems. So I'll pause here. I'll get perspectives given the time that we have.
I feel so strongly about this one. We have a huge, I'm going really crypto native with this, but even saying on a single blockchain, settlement finality is settled. Like, so on the XRP ledger, we offer single block finality. This, in a payments company at scale, is huge. It means so we're working with Aviva and Franklin Templeton on repo POCs. The repo POCs require DVP. Okay, DVP requires to have an account where both parties making the trade sign for the transaction, and then the transaction happens at the same time, simultaneously, 100%. While that is possible on a proof-of-stake-based chain, which is Ethereum-based, Optimism, there's a million of them, there is a non-zero risk forever that that transaction gets overturned. Which, and to be fair, that's totally alarmist. If you wait 40 minutes, the likelihood that transaction gets overturned is really, really low. However, in our Ripple's mint burn product, we're quite conservative about what we call settled on all of those chains, which means sometimes our customers who are using a different custody platform that's more aggressive, it says settled to them in Fireblocks, for example, because Fireblocks, you can configure it to wait just 6 blocks, so it can happen really fast. Yeah. But then to us, we wait 20 blocks for settlement to be more conservative, to make sure we have the stablecoin before we release anything from the reserve. And that is a huge problem. Like that, it doesn't scale at all. And so both Stellar and the XRPL have this single block settlement finality, which how have we sort of aggregated liquidity on these different chains so far? It's been really attributed to brand. And I will say I'm very excited that these features and the actual usage of these chains will more and more start to drive those decisions, because we're getting more mature businesses who you can't deal with a lack of consensus on finality.
Since we only have a few minutes left, I wanted to touch on that point that you were making about, you know, you said there's millions of chains and EVM compatible and whatnot, and we already alluded to liquidity being important, and then comes the issue around fragmentation. And you have all these different settlement layers, different settlement assets with unique features, all of them, and it's an emerging ecosystem, so liquidity is being spread thinner and thinner. What's your take on how compatibility will be addressed, and is there a solution? And since probably this will be the last round that we're going to do, how do you see any other like existential challenges that digital asset settlement is facing currently in that context?
That's real. That's really interesting because I truly believe that because with so many chains, different protocol, different settlement mechanism, liquidity is going to become a huge problem. So eventually, I think what the industry will be converging to is more a consensus or even a mechanism that we would be able to leverage each other capability to make sure that the liquidity is spread across all the chains and different protocol and different parties.
I kind of like that. I think that is probably right. I think there is room for a number of different assets if they're providing value. And so independent value, when you pull them together, you want to create incremental value. I think fragmenting liquidity for like same type assets is where we have some issues. And so I think there are some innovations. You know, Circle has their CCTP product that allows for kind of mint and burn across chains. I think things like that work. There needs to be that transitional element across all of them. Ultimately, though, I do believe there's probably like one version of consensus that will start to be a little more dominant, and I think that will help drive a lot of value. Ultimately, I think that is the issue that we have to solve overall, though.
And I think, I mean, we've seen humans build in TradFi. We have 1 million banks. We have 1 million ledgers. We have central bank ledgers and commercial bank ledgers. There's 1 million asset types. I think that is going to continue. We should expect that. I think in that world, businesses will look for sort of a one-stop shop where they can get all of their digital asset infrastructure. I think at Ripple, we see this as, you know, if you need payments, Ripple can provide you payments as well. Okay, now you need to accept the different tokens. We have Ripple Custody, which you can provide. I think the distribution model of stablecoins is trying to bring together some sort of equalized liquidity across every venue. But I guess that's to say, I don't think we have a great answer yet. And I do think it's going to end up looking somewhat like our current banking network. I think that we are going to have some fragmentation, and there's going to be providers that sit in the middle of these different pieces and are able to help with that.
I get to say the last word in the middle of time. I would say that Rails are commoditized, and I'm going to solve this at an operating layer, which is combination of the various systems and eventually something like a CCTP at the institution and asset-wide system, because it's impossible to solve the commoditized Rails problem at the moment. So thank you.
Yeah, well, thanks to all the members of the panel here, and thanks everybody in the audience. It's been great. Thanks.